$1 in 1990 had the same purchasing power as approximately $2.30 today. That gap did not happen because of market forces nobody could control. It happened because institutions with the authority to manage it chose to let it happen at a specific, targeted rate every single year. Here is a number worth calculating before we start. Take whatever amount you have in a savings account right now. Look at what it can buy today. Now consider that the institution responsible for managing monetary policy in your economy has an official target of 2% inflation annually. Not maximum, not ceiling, but target. At 2% annually, compounded over 30 years, the purchasing power of that savings account balance falls by approximately 45%, nearly half. Not because anyone took it, not because you spent it, but because the money supply was deliberately expanded at a rate that reduced what each unit of currency could buy. The number in your account stays the same. However, what it can purchase does not. This is the most important financial concept that most people never fully internalize. And it matters because the decisions you make about where to hold money, for how long, and in what form, those decisions interact with this mechanism in ways that produce dramatically different outcomes over a working lifetime. By the end of this video, you will understand exactly how purchasing power erosion works, who manages it, what the lifetime math looks like in concrete terms, and what the difference is between positions that lose to it and positions that stay ahead of it. Let us start with what purchasing power actually means and why most people misunderstand it. Most people think of inflation as prices going up. That framing is accurate, but incomplete. What is actually happening is not that things are getting more expensive. It is that the unit of measurement being used to price them, the dollar, the pound, the euro, is getting less valuable. The distinction matters because it changes who bears the cost. When prices go up because a specific commodity becomes genuinely scarcer, a drought reduces the wheat harvest, disrupting food supply. That is a real-world event affecting the actual supply of something people need. When prices go up because more money is chasing the same quantity of goods, because the money supply expanded, that is a monetary event affecting the value of the currency itself. In the first case, the cost is borne by everyone who needs wheat. In the second case, the cost is borne specifically by people holding the currency whose supply expanded, people who hold cash, people who keep savings in low-yield accounts, and people whose wages have not kept pace with the money supply expansion. And critically, the people who benefit from the second type of inflation are specific and identifiable. Governments that carry large debts denominated in the currency being inflated because the real value of that debt shrinks as purchasing power declines, benefit. Asset holders also benefit because assets priced in the inflating currency rise in nominal value, even when nothing about the underlying asset changed. Borrowers generally benefit as well because they borrowed money with higher purchasing power and repay it with lower purchasing power. This is not an esoteric economic point. It is a direct description of who pays and who benefits from the sustained monetary expansion that has characterized developed economies since the gold standard was abandoned. Understanding this reframes every financial decision you make. Saving cash is not neutral. It is a slow loss against an ongoing dilution. Holding assets, property, equities, productive businesses is not speculation. It is the structural response to a known, permanent, institutionally managed mechanism. The wealthy understood this because their financial advisors and generational knowledge transmitted it to them. For most people, nobody ever framed it this clearly. This is the frame. Now, let us talk about who actually controls this process and what their decision-making looks like. In every major developed economy, the rate of monetary expansion, and therefore the baseline rate of purchasing power erosion, is primarily determined by the central bank, the Federal Reserve in the United States, the European Central Bank, the Bank of England, and the Bank of Japan. These institutions set interest rates, conduct open market operations, and in more recent history have engaged in programs like quantitative easing that expand the money supply directly. Their stated inflation target, in most cases, is 2% annually. This target is not chosen arbitrarily. There is genuine economic reasoning behind it. Zero inflation or deflation, where prices fall, creates its own economic problems. When prices fall, consumers delay purchases, waiting for things to get cheaper. Delayed spending reduces economic activity. Reduced economic activity leads to unemployment, and contraction. This deflationary spiral is a genuinely destructive economic phenomenon that several historical episodes have demonstrated clearly. So, some positive inflation rate is considered preferable to zero. The question is, what rate to target? The 2% target emerged from a combination of economic modeling, historical experience, and policy consensus that developed primarily in the 1990s among central banks in inflation targeting regimes. It provides a buffer against deflation while remaining low enough, in theory, to avoid the economic distortions that come with high inflation. This is the official rationale. But here is what the 2% target also does that rarely appears in the official rationale. It benefits governments with large debt loads. As we covered in our video on the 1971 decision, governments borrow in nominal terms and repay in nominal terms. A 2% inflation rate means the real value of government debt, its actual purchasing power burden, shrinks by approximately 2% per year without any explicit repayment. Over the 10 and 20-year terms at which governments typically borrow, this is a substantial implicit subsidy to government finances at the expense of currency holders. Central banks are technically independent of direct government control in most developed economies, but they are staffed by people who move through a professional ecosystem that includes government finance, private banking, and academic economics, a revolving professional world where certain frameworks and assumptions about desirable inflation rates have become deeply institutionalized. There is also a second structural beneficiary that is worth naming: the financial system itself. Moderate positive inflation encourages spending and borrowing over saving and hoarding. A world where cash reliably loses value is a world where people are more likely to put money into financial products, markets, funds, loans, rather than keeping it under the metaphorical mattress. That flow of money into financial products generates fees, returns, and economic activity for the financial industry. A deflationary world, where cash gains value over time, would reduce the incentive to deploy cash into financial products, which would substantially reduce financial industry revenue. This does not mean the 2% target was cynically chosen to benefit banks. It means that the consensus around it formed in an environment where multiple powerful institutional interests happened to align with its maintenance. That alignment is worth understanding clearly, because the 2% target is not a law of nature. It is a policy choice made by people within institutions with their own incentive structures. And it comes out of your purchasing power every year, whether you voted for it or not. If understanding who manages this process and why changed how you think about your savings account balance. Stay with me, because the mechanism and the decision makers are only part of this. The lifetime math, what 2% annually actually costs you in concrete purchasing power terms across a working career, that is what comes next. And the number is larger than most people expect. Here is the lifetime calculation that changes how this feels. Most people think about inflation 1 year at a time. 2% this year feels manageable. 2% next year feels manageable. But compound effects do not work 1 year at a time. They accumulate. Let us run the numbers concretely. You graduate from school at 22 and enter the workforce. You begin earning a salary and accumulate savings over your working life. Over 43 years of working life, to age 65, at the Federal Reserve's stated 2% annual inflation target, the purchasing power of $1 held continuously in cash over that period falls to approximately 42 cents. Not 42% less, 42 cents on the dollar. A person who retired at 65 with $100,000 in savings that they held entirely in a zero-interest account since they were 22 would have the purchasing power of approximately $42,000 in today's terms. $58,000 of purchasing power, more than half, quietly eroded by the compounding effect of a 2% target applied consistently over a lifetime. Now, here is what makes this particularly important to understand. Wages do not always keep pace with even the official inflation target. For the median worker in developed economies, real wage growth, salary increases above the rate of inflation, has been modest over extended periods. In the United States, for example, research on median real wages shows that for significant periods since the 1970s, wage growth for middle-income workers has not meaningfully exceeded the inflation rate. A person whose wages kept pace exactly with inflation over a career would have the same real standard of living at the end as at the beginning. A person whose wages grew below inflation, which many workers experience in specific industries and regions, would have experienced a real decline in living standard over their career. This is not visible in the nominal wage figure, which may show steady increases. It is visible only when you compare nominal wages to the purchasing power of what they can buy. The number goes up. However, what it buys does not always follow at the same rate. Understanding this gap between nominal and real is the foundation of understanding why financial position erodes even for people who feel like they are doing everything right. Here is what changes when you understand purchasing power erosion as a structural mechanism rather than a vague economic backdrop. First, reframe your relationship with cash. Cash is a transaction tool and a short-term liquidity reserve. It is not a long-term store of value in a 2% inflation world. Money you will not need for 2 or more years should not be sitting in an account paying below the inflation rate, because it is guaranteed to lose real value every year it sits there. That is not a risk, that is a certainty. Second, understand that inflation protection is not the same as investment speculation. Broad market index funds, real estate, treasury inflation-protected securities, and I-bonds are all instruments designed or historically demonstrated to preserve or grow purchasing power over long time horizons. Holding these is not a bet on the market going up. It is the structural response to knowing that cash will go down in real terms. Third, understand that your salary negotiations are purchasing power negotiations. A 3% raise in a 4% inflation year is a real pay cut. Framing salary discussions around real purchasing power, rather than nominal percentage change, gives you a more accurate view of whether you are actually moving forward financially. Fourth, run the lifetime calculation for your own situation. Take your current savings balance, apply 2% annual erosion, and see what that balance buys in 30 or 40 years if it sits unchanged. Then, compare that to what it could become in an instrument that historically beats inflation. That comparison is the clearest possible argument for acting on this knowledge, rather than simply understanding it. The mechanism runs, whether you understand it or not. However, understanding it, at minimum, means it no longer runs uncontested. The dollar in your pocket loses value every day, not by accident, not because of bad luck, because of a deliberate, documented, institutionally managed policy choice that has been running continuously for decades. The people who understand this structure hold money differently, negotiate salaries differently, and make financial decisions differently, not because they are smarter, but because they have the frame. Now you have the frame. Share this with one person who has ever wondered why the same money seems to buy less every year. And if you want to keep understanding the mechanisms quietly shaping your financial life, subscribe to Hidden Truth Files. Hidden no more.